In this video, I'll discuss how to make financial projections when you have explicit information about the company for which you're making projections. This would typically happen if you are inside of the company and have access to their 5-year plans, for example. Now, note that every company does need some sort of financial projections. They'll need to make sales projections and at least have a good idea of what they're expecting sales to be. So they'll have enough inventory on hand. They'll need to make projections of inventory, so there'll be enough money on hand in order to purchase the inventory. They'll need to have some idea about what their production will be so that they'll have enough manufacturing capacity, and they'll need to have an idea of how much plant, property, and equipment they'll need so that they'll have enough money to make sure that they can purchase any equipment that they need. So everything associated with these projections is really important for the company's operations. So inside of a company, this type of information is really important. It's typically analyzed every year, and they do this extensively for 5-year plans as well. So if you're preparing projections from inside of a company rather than as an external analyst, then presumably you're going to have some specific information regarding all of this from their annual and 5-year planning process. Now, in order just to calculate free cash flow, all we need are the operating items, and rather than everything for the financial statements, we'll need EBIT or operating profit. We'll need tax rate. We'll need assets other than short-term investments. So basically, we're going to need all of the assets, projections for all of the assets, and then we're going to need projections for operating liabilities, which are basically basically accounts payable, accruals, anything that's a short-term liability except for short-term debt or notes payable. Everything else on the balance sheet and all of the other items on the income statement that are below EBIT are either financing decisions themselves or come from a financing decision, and that would include interest income, dividends, short-term investment balances, short-term debt, long-term debt, and what ultimately is your equity level. So all of those are financing decisions, not operating decisions. Now, we're going to talk about both financing decisions and operating decisions, but remember that all we need are the operating items if we want to calculate free cash flow. So for the free cash flow model, we don't need to project debt level or interest expense, but we will do so because having complete financial statements is very important. So follow along if you want to on the file exampleprojections.xlsx, and the tab is specific information tab, and you can follow all these calculations along on the Excel file. So the next 3 slides are going to show information for our company, Vol Incorporated. We have some sales. We've got some cost of goods sold, selling, general, administrative expenses, all the way on down to dividends and additions to retained earnings for the current year. For the current year on the balance sheet, we've got some assets, short-term investments, accounts receivable. Notice out of all of these assets, basically everything is an operating asset except for short-term investments. On the liabilities, we have mostly financing decisions on the liabilities, and this is always the case. However, accounts payable is an operating liability, accruals is an operating liability, and basically everything else is a financing decision, including notes payable and short-term debt. So here are some things we know about our projections. We're expecting sales to increase by 10%, and we're anticipating that our gross margin is going to remain the same. That is, our sales minus cost of goods sold divided by sales will remain constant. Another way of saying that is that cost of goods sold as a percentage of sales will remain constant. Selling, general, administrative expenses are going to have to increase by 20% to support a new plan that we've got going on. Depreciation of existing assets will be 45, and that's basically from the depreciation schedule that we have for the existing assets. Tax rate will be 25%, and we anticipate paying out roughly 30% of our net income as dividends. And based on that information, we can partially complete our income statement. Sales are going to grow 10%, and so that means that we can identify sales being 10% more than 1,000 or 1,100. Cost of goods sold as a percentage of sales is going to remain the same. Well, cost of goods sold was 60% of our sales, and so 60% of 1100 will be 660. Selling general administrative expenses will increase by 20. And depreciation from our depreciation schedule will be 45 because we've liquidated some assets. And our operating profit is calculated to be 275. We don't know what interest expense will be. We can't calculate profit before taxes or net income or dividends. Nothing below EBIT is calculatable at this point. Now, we also know on the income statement and the balance sheet that any new debt that's going to be issued will be issued towards the end of the year. And we're making this assumption to make life a little bit easier for us. Any new debt is going to be issued at the end of the year, and any debt paid down is going to be paid down near the end of the year. And that means that interest expense for the year is mostly going to be based on debt levels from the beginning of the year. And so, for example, when we're looking over here at interest expense, it says we don't know what it is. Well, we don't, but fortunately, we're going to be able to base interest expense on what debt looked like at the beginning of the year, which is the end of the current year. Turns out disentangling interest expense from current year's debt makes life easier in terms of projections. Now, we've also got an interest rate on long-term debt and short-term debt. And so we can observe that interest expense is going to be 4% of short-term debt, 6% of long-term debt, and I'm going to back up for this. We know that on the liability side of the balance sheet, we already had short-term debt of $700, and we had long-term debt of $1,500, and so we can use that information for projecting what interest expense is going to be in the first year of projections, or a total of $118. Once we have that information, we can then calculate profit before tax. We can calculate taxes at 25%, net income, and we can also project dividends based on a 30% payout of 35, and so our additions to retained earnings, 118 minus 35, will be 83. Based on this information now, we can do an awful lot with the income statement and with the balance sheet side of this. But before we move to the balance sheet, let's notice that we do have enough information already to calculate net operating profit after taxes, which is the first component of the free cash flow calculation. We have EBIT, which is 275. And from that, we can multiply by 1 minus the tax rate, or 1 minus 0.25, to get projected net operating profit after tax of 206.25. That's what we would use for the first part of our free cash flow calculation. Now, when we talk about what we know about assets, well, we've got to make some assumptions. We're happy with the level of cash and the level of short-term investments, and so we'll assume for now that those will remain the same. As far as accounts receivable, we'll assume that days sales outstanding remains the same, which means that we're going to have the same collection policy that we had before, days sale outstanding being 365 times accounts receivable divided by sales. Inventory turnover, we're going to assume that those will roll over at about the same rate, so we'll leave inventory turnover the same. We think that we're going to need to invest $200 in new equipment, and we're not planning any other acquisitions, and so intangibles will remain the same. And for accounting purposes, intangibles are not depreciated. So for financial statement purposes, they're not depreciated. So our balance sheet is going to look like the following. We're going to leave income statement the same. We're going to leave cash the same. We're going to leave short-term investments the same. We're going to project accounts receivable based on a constant days sales outstanding. We're going to project inventory based on a constant inventory turnover, or cost of goods sold over inventory. Well, once we have those projections, we can calculate total current assets. Net fixed assets are going to increase, but we have to do a little bit of a calculation to figure out how that's going to work. Gross fixed assets are going to go up by 200, but we have some depreciation that's going to get charged. Intangibles are going to stay the same for the current year. So here are what our calculations are going to look like. Day sales outstanding is currently 109.5. We're taking quite a while to collect our accounts receivable, 109.5 days on average. And so that means that we're going to project our accounts receivable to be 109.5. That's the day sales outstanding multiplied by 1100 divided by 365, or 330. So that's going to be our projected accounts receivable. Inventory turnover is currently 2.4, which is pretty slow, but inventory turnover is going to projected to be the same for now. And so that means our projected inventory is going to be cost of goods sold, projected cost of goods sold divided by 2.4, or 275. Now here's the calculation for net fixed asset that's just a little bit complicated. Projected net fixed assets for this first year of projections will be last year's net fixed assets plus any gross purchases minus any depreciation charge that we've had. Well, we know that we're going to charge $45 off in depreciation. We want $200 worth of gross fixed assets purchased, and so our net fixed assets for our first year of projections will be net fixed assets for the most recent year plus 200 minus 45, or 1955. So here's what our balance sheet is going to look like based on those projections. Our cash is going to stay the same. Our short-term investments is going to stay the same. DSO is going to increase to 330. Accounts receivable will increase to 330, and that's because our day sales outstanding remain the same. Inventory is going to increase to 275 because our inventory turnover remains the same. We added up to get total current assets. We did the calculation for net fixed assets, and so that's increasing by 1955, and then intangibles remain the same for a total assets of 3710. Now, on the liability side, we do know some things as well. We'll assume for now that our payables deferral period is going to remain the same. In other words, we're going to take just as long to pay our suppliers as we are currently taking to pay our suppliers. And we'll assume that accruals as a percentage of sales will remain the same as well. We're not going to issue any new equity. We're going to pay down our notes payable by $300 and roll over the rest of our notes payable. And any new financing that's required is going to be financed with long-term debt. So here's what our beginning liability side of our balance sheet is going to look like. Our accounts payable are going to be calculated using the same payable deferral period. We'll calculate that on the next slide. Accruals will be the same percentage of sales. Our short-term debt's going to decrease by $300. We're not going to issue any new equity, so our par plus paid-in capital less treasury is going to remain the same. But we have a variety of other items that we do need to calculate based on our assumptions. So to finish all of this up, our payables deferral period is currently pretty high. It's 121.7 days. That is a long time paying our suppliers, and so they're probably pretty unhappy about that. But if we assume that it's the same, our payables, our new payables are going to be the payables deferral period multiplied by 660 divided by 365, or 220. So our payables are going to be 220. Our accruals as a percentage of sales is currently 10%, and so that means our accruals as a percentage of sales after our sales grow will now be 110, and our new retained earnings will be, as you always calculate retained earnings, our old retained earnings plus any additions to retained earnings, and so we already calculated our additions to retained earnings would be 83, so our new retained earnings will be 600 plus 83, or 683. And so now we have most of our items filled up on our liabilities side. Our assumptions about payables deferral period allowed payables to go up to 220. Our accruals increased to 110. Our short-term debt declined to 400 for a total current liabilities of 730. We haven't figured out how much long-term debt we need, and we will in just a second. And so when we add up everything except for our long-term debt, we notice that we need 1,897 shortfall. We end up having all of our total liabilities and shareholders' equity to add up to 1,813. We need 1,813 we need on the asset side. We need 3710. That's what our assets need to be. Our total assets is 3710, so our total liabilities and equity needs to be 3710. We've got 1813, and so that leaves us a shortfall of 1897, which is what's going to have to be our long-term debt amount. Well, we've already got 1500 in long-term debt. We're going to roll that over, and we're going to need to issue another 397 in short-term debt. So based on all of our specific information, we're going to need to add $397 in short-term debt. And that's what our CFO is going to have to arrange for. For many companies, just to remind you, there's going to be specific plans for this, and they're going to know how much short-term debt, long-term debt they're going to be adding. They're going to know what the assets level are supposed to be over the next several years, all of this. For some companies, however, for especially small companies, there may be only vague expectations about what's going to happen. Especially, they may only have an idea about what sales is going to be over the next 6 months, and that's about it. So there will be there's a wide variability in how much information is available. Large companies have extensive planning processes and will have good plans probably out 5 years. Small companies, especially mom and pop industries, may not have any idea what their financial statements are going to look like over the next 4 years and 5 years, and what those plans might be. They may not even have a good idea what it's going to look like over 6 months. So the challenge for projecting financial statements is with the smaller, albeit more interesting firms to value.